All right, let's talk about 2026. What's the story for the global economy? Today, we're diving into the thinking of two financial heavyweights, Fidelity and UBS. And it turns out they're both wrestling with the same massive question. A question that could define the next few years for all of us.
And here it is. This is the core question, coming from UBS, and it's a powerful one. Can the global economy actually achieve escape velocity? You know, what they're really asking is, do we have enough momentum from all this new technology to finally break free from all the things holding us back?
So, what do we mean by escape velocity in economic terms? Well, think of it just like a rocket ship. It's the speed we need to break away from the huge gravitational pull of things like rising debt, all the political craziness, and inflation that just won't seem to go away. It's a huge challenge.
To get that kind of speed, you need a heck of an engine. And right now, the one force that could provide that incredible propulsion is artificial intelligence.
And just look at the fuel being poured into this thing. UBS is projecting a mind-blowing $4.7 trillion in global AI investment by 2030. Seriously, let that number sink in for a second. That is an absolute tidal wave of money that is set to completely reshape our world.
So where's all that cash going? It really helps to break the AI world down into three layers. First, you've got the enabling layer. This is the guts of the operation. You know, the chips, the servers, the infrastructure. Then comes the intelligence layer. This is the software, the algorithms, basically the brains. And finally, you have the application layer. This is the stuff you and I actually see and use, and everything from our phones to robots on a factory floor.
Okay, but wait a minute. Whenever you see numbers this huge and hype this big, you have to ask the question, right? Are we just living through another tech bubble that's waiting to pop?
Well, Fidelity took a hard look at this, and they're saying no, this time is fundamentally different. See the dot-com bubble back in the 90s? That was fueled by debt and pure speculation on companies with no profits. Today's AI boom is being paid for with real cash flow and record earnings from some of the most profitable companies on the planet. So the big takeaway is, yeah, prices are high, but the foundation is built on actual profit, not just promises.
Now, AI is the big, shiny engine for sure, but it's not working in a vacuum. There are other powerful forces, these tailwinds, that are giving the global economy a real push forward. So let's look at the signals.
Fidelity is watching three things in particular. First, profits are growing, and not just for the usual tech giants. It's spreading out. Second, central banks are likely going to start cutting interest rates, which is like a booster shot for the economy. And third, a weaker US dollar, which sounds bad, but it can actually make your investments overseas way more profitable.
And that first point is a really big deal. For years, it felt like just a handful of giant companies were pulling the whole market up. But now, that strength is spreading out to medium and even smaller companies. It's like a whole forest getting healthier, not just one giant tree growing taller. That's a great sign.
This all ties into the bigger global picture. As Anu Gaggar from Fidelity puts it, the rest of the world is slowly looking for alternatives to the US dollar. So why does this matter to you? Well, it's pretty simple. When the dollar weakens, any money you've made in, say, euros or yen is suddenly worth more when you convert it back home.
Okay, so we've seen the powerful forces pushing for liftoff. We've talked about the rocket fuel. But now we have to talk about the gravity. The huge, powerful headwinds trying to pull the economy right back down to earth. One of the biggest things making investors nervous right now is that stocks just feel, well, expensive. Fidelity has a great term for this, potential noise. It's like a scary headline that grabs all the attention, but might not be the real story. And it's true, stocks are definitely not cheap right now.
But here's the counter-argument from Fidelity's own Denise Chisholm. She says that high valuations don't automatically mean a crash is coming. Instead, they can be a sign that the market is really confident about strong earnings in the future. In her words, valuations might just stay higher for longer.
But here's a gravitational force that is definitely not just noise: debt. I mean, this chart says it all. As a chunk of the entire U.S. economy, federal debt has basically tripled since 1980. This isn't a headline. This is a massive structural weight on our long-term future.
So yeah, the risks are very real. It's not just the debt. You've got to keep an eye on inflation sticking around, geopolitical shocks from out of nowhere, and even political pressure on the central banks. Any one of these could throw a wrench in the works and pull us right back down.
So you've got this massive rocket engine on one side and this incredible gravitational pull on the other. What's an investor supposed to do with all this? How do you map out your own flight plan for 2026?
Well, when you boil down all the advice from both UBS and Fidelity, a pretty clear three-point plan comes into focus. First, focus on those huge, long-term trends that aren't going away, like AI, the need for more power, and longevity. Second, and this is timeless advice, diversify. Don't put all your eggs in one basket. Spread your money across different assets in different parts of the world. And third, build in a parachute. Hedge against the big risks with things like quality bonds and gold that can give you some stability when things get choppy.
And I think this quote from Anu Gagar really just captures the perfect mindset for all of this. She says, "In no single year is the market ever calm." And that's the key, isn't it? Volatility is a given. It's not something to be afraid of. For an investor who's prepared, it's actually where you find the opportunities.
And so that brings us right back to where we started. The propulsion we're getting from innovation is undeniable. It's real. But that gravitational pull from debt and risk is just as real. In the battle for 2026, which of these two incredible forces will win out? Well, that is the multi-trillion-dollar question.